Welcome back to the deep dive, where we really try to unpack complex ideas and hopefully make them crystal clear for you. Today, we're tackling one of those really persistent riddles in financial markets. I mean, for decades, it's been this phenomenon so baffling that honestly, many of the sharpest financial minds have sort of thrown up their hands. They basically concluded it must simply be, irrational investors at play. I'm talking about momentum, that really intriguing observation that stocks doing well recently, well, they often keep doing well. And conversely, the ones struggling tend to keep struggling. It's a real cornerstone anomaly, a genuine head scratcher in finance. For a very long time, the, let's say, prevailing wisdom, and this was backed by a huge body of empirical research. We're talking landmark studies here like Jagadish and Titman back in 93 or Bernard and Thomas in 89. It all strongly pointed towards behavioral explanations. The narrative was really all about the human element, right? Investor underreaction to new information, maybe slow information diffusion across the market, or even those subtle biases like overconfidence creeping into how people make investment decisions. Our own human psychology, it seemed, was the likely culprit behind these predictable patterns. But what if there's an entirely different angle, a more, maybe, fundamental explanation? What if momentum isn't just about the quirks of human psychology, but actually a direct reflection of the core economic decisions that firms themselves make? That's what we're diving into today. We're going to explore a truly groundbreaking paper by Laura Chalet-Liu and Lu Zhang from 2014. Their work offers a neoclassical interpretation of momentum. It grounds it firmly in the first principles of how companies invest and operate. So our mission for you today is to really get a handle on this alternative perspective. See precisely where it brilliantly illuminates market behavior and also critically acknowledge where the puzzles still remain. By the end of this deep dive, the goal is for you to have a richer, much more nuanced understanding of one of finance's most enduring mysteries. Okay, so when I talk about momentum in the stock market, what exactly are we defining here? And why has it caused such a stir, among academics and investors for so long? At its heart, we're generally looking at two primary forms. The first one is price momentum. This is the idea that stocks delivering high recent performance, and that's typically measured over, say, a 3 to 12-month period. They tend to continue earning higher average returns over the next 3 to 12 months. It's essentially like a winning streak that seems to keep going, at least for a while. Jagadish and Titman, in their really famous 1993 research, they documented this clearly. And their conclusion was basically that the market underreacts to information about the short-term prospects of firms. Now, that was a powerful challenge to the idea that all information gets instantly baked into stock prices.
All right, the efficient market idea.
Exactly. It suggests that news, good or bad, isn't fully incorporated into prices as quickly as that efficient market theory would predict. It takes time. Then the second type is earnings momentum. This is often called post-earnings announcement drift, or PEAD for short. This phenomenon highlights that stocks experiencing big earnings surprises, meaning they significantly beat or miss what analysts were expecting. They tend to keep earning higher average returns over the next 12 months after that announcement.
So the surprise itself has legs, essentially.
Precisely. This drift was first noted way back in 1968 by Ball and Brown. Much later, Bernard and Thomas, in their 89 paper, really emphasized that this specific evidence cannot plausibly be reconciled with arguments built on risk mismeasurement, but is consistent with a delayed price response.
So they were ruling out risk explanations.
Yeah, essentially saying it's not just about risk. It looks much more like the market takes its sweet time fully digesting the implications of strong or weak earnings news. And that leads to this predictable drift, up or down, long after the initial news hits.
Okay, so given these pretty powerful observations that past performance, whether it's stock returns or earnings surprises, seems to consistently predict future performance, the immediate question for anyone in finance is pretty direct. Why? I mean, in a market that's theoretically built on efficiency, where all available information gets priced in instantly, well, this just shouldn't happen.
Right. It flies in the face of the basic theory.
Exactly. And that's precisely why momentum gets labeled an anomaly. It directly challenges that bedrock assumption of the efficient market hypothesis, which, posits that stock prices fully reflect all available information at any given time.
Yeah.
If prices consistently underreact or react slowly to news, that creates predictable patterns. And those patterns, in turn, imply potential opportunities for investors to profit.
Opportunities that shouldn't exist, theoretically?
Correct. In a truly efficient market, sophisticated investors should spot these patterns and trade on them immediately, essentially arbitraging them away. But momentum profits have proven to be stubbornly persistent over decades. And what's really remarkable here, I think, is that this isn't some fleeting observation. It wasn't a statistical fluke that just disappeared after someone first wrote about it.
No, it's stuck around.
Definitely. Building on those early works, later studies have extensively confirmed momentum profits across a really diverse set of circumstances. It solidified its status as this pervasive market phenomenon. For instance, uh, Ruenhorst back in '98 showed that momentum profits aren't just a U.S. thing. They exist in international equity markets too.
It's just crucial for showing it's not just one market's quirk.
Absolutely. That was a key step, showing its global reach.
Yeah.
And then more recently, Asness and his colleagues in a 2013 paper provided even broader evidence. They documented consistent momentum profits across 8 diverse markets and asset classes.
8. Wow, what kind of things are we talking about?
Well, everything from country equity, index futures, government bonds, currencies, even commodity futures.
So across the board, basically.
Pretty much. This kind of widespread confirmation across different instruments and geographies really underscores how robust it is. And on top of that, momentum has been shown to interact in predictable ways with various firm characteristics, things like company size, analyst coverage, trading volume, credit ratings, even stock return volatility.
So it pops up everywhere, regardless of these other factors.
Its pervasive nature, often independent of these other characteristics, just makes it an even more compelling puzzle to solve.
Okay, so if this thing is so robust, so persistent, how have researchers typically tried to make sense of it? Because for a long time, the go-to explanation, the dominant one, has focused squarely on us, on human behavior.
Right, the behavioral finance angle.
Exactly. Behavioral finance stepped in and offered some pretty compelling reasons why investors might not always act, perfectly rationally, leading to these kinds of predictable patterns. One of the leading behavioral explanations is called conservatism. This theory, championed by influential researchers like Barbaras, Schleifer, and Vishny back in '98, suggests that investors are just, well, slow to update their beliefs when they face new information that conflicts with what they already think.
Like clinging to an old view.
Pretty much. Imagine you're convinced a stock is a winner. Then some slightly negative news comes out. Conservatism suggests you might cling to your initial positive view for longer than you really should, causing the stock's price to adjust only gradually, not instantly.
And that gradual adjustment is the momentum.
Exactly. The market slowly catches up to the full implications of the new data, creating that momentum effect. Then there's another idea: self-attribution over confidence. Daniel, Hirschleifer, and Subramaniam, also in '98, explored how investors often attribute successes to their own skill. I'm a genius for picking that winner.
What?
But failures, those are often blamed on bad luck or the market just didn't get it right.
Right, the classic bias.
Yeah. This cognitive bias can lead to an inflated sense of confidence in your own judgments. So, consequently, you might underreact to info that contradicts your positions, or maybe even overreact to info that confirms them.
And that messes up decisions.
Right. This biased decision-making, whether it's clinging to losers too long or piling into winners too fast, can generate the very momentum patterns we observe. And finally, another really prominent theory is slow information diffusion. Hong and Stein, in their '99 paper, proposed a model where information just doesn't spread instantly or evenly through the market, nor is it processed uniformly by everyone.
Especially for smaller companies.
Exactly. It's particularly relevant for smaller, less followed firms where fewer analysts are watching and news just travels more slowly. The idea is that information gradually diffuses from those maybe in the know, perhaps with private insights to the broader public.
So it takes time to ripple out.
Precisely. Because information takes time to disseminate and be fully incorporated into the collective understanding, it creates a gradual, delayed price reaction. So if genuinely good news slowly leaks out and gets processed over time, the stock price will gradually climb, showing that classic momentum behavior. These behavioral explanations, they've been incredibly influential. They provide intuitive, often quite relatable frameworks for why momentum might exist, seeing it as a byproduct of our imperfect human nature.
Yeah, it's precisely against that backdrop, that whole body of well-established behavioral explanations, that this Liu and Zhang paper from 2014 makes such a powerful, almost revolutionary departure.
It really shifts the focus, doesn't it?
Completely. Instead of digging deeper into human psychology or cognitive biases, they ask a radically different question. Can we explain momentum using the first principles of how firms operate and make investment decisions? This represents a significant return to, well, neoclassical economics. It aims to ground stock returns not in investor sentiment or irrationality, but in the real, tangible economic activities of the firms themselves.
So, moving away from the investor's brain and looking at the company's actions.
Exactly. It's a fundamental shift in perspective for understanding such a prominent and persistent market anomaly.
Okay, let's really delve into the heart of this neoclassical investment model then, because as you said, it boils down to how a firm decides to use its capital.
Yeah.
Let's imagine a company, maybe that shoe manufacturer example is good, trying to make rational choices about where to put its money to maximize its long-term value.
Standard economic assumption.
Right. The central idea, the main tenet of this model, is that expected stock returns are intrinsically linked to something specific. The expected marginal benefit of investment divided by the marginal cost of investment.
Okay, let's unpack that a bit.
Sure. Put simply, a company will rationally choose to invest more, maybe build a new factory, buy new equipment if the additional profit it expects to generate from that investment is high relative to the cost of actually making that investment.
Just a basic cost-benefit analysis at the firm level.
Exactly. It's fundamental business sense. Now, through this lens, the model offers a very intuitive explanation for those winners and losers we see in momentum. Those winning stocks, the ones with high past returns, they're viewed as firms that just inherently have higher expected future growth and higher expected profitability.
So better prospects.
Right. Maybe they've developed a hit new product or they've tapped into a market that's booming. These higher expectations translate directly into a higher expected marginal benefit of investment for these firms.
Makes sense. More bang for their buck if they invest.
Precisely. So it follows quite logically within this framework that these winners with their more attractive, more productive investment opportunities should naturally command higher expected stock returns than the losers,
And the losers would have lower expected growth, lower profitability.
and thus lower expected marginal benefits from investing. The market, in this neoclassical view, is simply and efficiently valuing these underlying firm characteristics and their future potential. It's pricing in the quality of their investment opportunities.
And if we connect this to the bigger picture, the model posits this direct, it's almost an identity-like link between a firm's stock returns and its real economic activities. Under specific theoretical conditions, constant returns to scale is a key one. The stock return for a firm is essentially what they call its levered investment return.
Levered investment return. Okay.
Yeah, and the paper gives a key equation to represent this mathematically. It looks like RSIT plus 1 wit, RBATE plus 1 wit. Now, let's maybe break that down intuitively for a second.
Please do.
Okay, what this equation is basically telling us is that the stock return, RSIT plus 1, that's the return you, as an investor, expect from holding the stock, is directly related to this thing called the levered investment return, RIT plus 1. Think of that levered investment return as the total return generated by the firm's actual assets, considering its use of debt, its leverage.
Okay, so the return on the business itself, factoring in debt.
Exactly. This is then adjusted by the firm's market leverage, WIT. That's just the proportion of its assets financed by debt and its after-tax corporate bond return, RBATE plus 1, which is basically the cost of that debt. So in essence, the stock's performance is driven by the underlying performance of the firm's real investments once you account for how those investments are financed.
Right, the financing matters.
It does. And crucially, the model aims to show that the expected difference between these stock returns and these levered investment returns, what we usually call the alpha in finance.
The unexplained part.
Right, the excess return. The model predicts that alpha should be effectively 0. RSIT plus 1, IRO plus 1 equals 0. This means, from this neoclassical perspective, there's no real excess return or unexplained premium floating around. The stock market is simply reflecting the firm's fundamental economic investment return. Momentum isn't alpha in the traditional sense, it is the expected return. Now, to really grasp this investment return itself, we need to understand its parts, the building blocks that drive it. The model breaks it down into several key components. First, there's the after-tax marginal product of capital. Think about adding one more machine to a factory. How much additional profit does that machine generate after taxes?
The direct output from the new capital.
Precisely. And this is directly related to the firm's sales-to-capital ratio, yet plus 1 kit plus 1. A higher ratio generally means the company is generating more revenue from each unit of its capital stock. High efficiency, strong demand, that sort of thing. Second, we have to consider the after-tax marginal reduction in adjustment costs. Firms don't just snap their fingers and invest. They incur costs when they adjust their capital stock, buying equipment, training staff, maybe restructuring operations.
It's costly to change things.
Right. The model incorporates these adjustment costs, often assuming a quadratic form like A2, it plus 1 kid plus 1 2. The intuition here is that making small adjustments might be relatively easy, but making large, rapid changes can become disproportionately more expensive or disruptive, hence the quadratic nature. And interestingly, sometimes investing more now can actually reduce the marginal cost of making adjustments later. So there's a dynamic effect.
Okay, that makes sense.
The third component is the marginal depreciation tax shield. This is simpler. It refers to the tax benefits a firm gets because its assets depreciate over time. Depreciation expenses reduce taxable income, lowering the tax bill, a standard accounting benefit.
Got it.
And finally, there's the marginal continuation value of an extra unit of capital. This term tries to capture the future value that an additional unit of capital will generate, net of its depreciation. It's acknowledging that today's investment isn't just about immediate profits, it's about the whole stream of future benefits it provides down the line.
So the long-term value.
Exactly. These components, all together, form the numerator of the investment return. They represent the marginal benefits. The denominator is, simply put, the marginal cost of investment. It's quite a comprehensive framework. And of course, the model operates under specific foundational assumptions. Firms are assumed to maximize their market value of equity. They use capital and other inputs optimally to maximize operating profits. They face these quadratic adjustment costs for investment, and a key parameter in their production function is ACA.
Kappa, what's that?
CAPA represents capital share and output. It basically indicates how much of a firm's output is attributable to its capital, as opposed to, say, labor or other inputs. It's crucial for linking investment to overall output.
Okay, that sounds like a really robust theoretical framework. But the big question is, how do Liu and Zhang actually test something like this with real-world data, especially when they're talking about things we can't directly observe, like expected returns and marginal benefits?
This is where their methodological approach gets genuinely innovative, I think. They use something called structural estimation, specifically the generalized method of moments, or GMM. Now, in simple terms, structural estimation is kind of like trying to reverse engineer a model.
Yeah.
Imagine you're trying to figure out how a complex clock works, but you can't open it up.
Right.
You can, however, watch the clock's hands moving, telling time. Structural estimation lets you infer the internal gears and mechanisms, the hidden parameters, just by observing the outcomes. So, working backwards from the data to the model's gut.
Exactly. In this case, Liu and Zhang estimate two key parameters from their model. A, which quantifies that adjustment cost for investment we talked about, and key, capital share and output. They do this by matching the average levered investment returns predicted by their theoretical model to the average stock returns actually observed in real-world momentum portfolios. This process effectively calibrates the model, tuning it until its predictions line up with what we see in the market.
But, and this is a really critical point, they faced a truly significant hurdle here, one that could have potentially undermined the entire effort.
Which was?
Momentum portfolios, as you know, are typically rebalanced monthly, based on recent stock price movements. But the crucial company accounting data, the stuff you get from Compustat, which is essential for calculating firm-level investment, capital, sales, etc., that data is typically only available on an annual or sometimes quarterly basis.
Ah, the timing mismatch. Monthly stocks, annual fundamentals.
Precisely.
Yeah.
You can't just plug annual data into a monthly model and expect accurate results. That timing mismatch, if you don't handle it with extreme care, could severely distort any attempt to link fundamental firm economics to monthly stock returns. It really should, on the face of it, present a huge challenge to identifying these fundamental forces behind momentum. And this brings us to their really crucial methodological innovation. A meticulously developed, what they call it, polished timing alignment procedure.
Sounds fancy.
It's quite sophisticated. It's a three-step process designed precisely to construct accurate monthly levered investment returns from annual accounting data. This allows them to perfectly match these fundamental-based returns with the monthly stock returns of the momentum portfolios.
Okay, how does that work?
This innovation significantly increased the power and precision of their empirical tests. It was key. Let's maybe walk through this three-step procedure, maybe with a hypothetical example to make it a bit more concrete. Imagine a firm, let's say its fiscal year ends in December. Step one involves carefully aligning firm-level characteristics, but they do it at the sub-decile level each month. The general principle is this. For variables representing current economic conditions, let's call them time t variables, like current investment to capital, they use accounting data from the fiscal year end that's closest to the current month of the momentum holding period.
Okay, using the most recent relevant annual data for current stuff.
Right. And for future economic conditions, time t plus one variables like next period sales to capital, they use data from the subsequent fiscal year end. So for our firm with a December year end, if the momentum portfolio is being analyzed for, say, June of year Y, the T variables might come from fiscal year Y1 or maybe Y, and the 2 plus 1 variables from Y or Y plus 1, depending on the precise timing definitions in the paper. This ensures the accounting data genuinely reflects the economic state of the firm relative to the stock returns being observed at that time.
That sounds incredibly painstaking.
It is. Step 2 then aggregates the components of the levered investment returns at this subdecile level. So for any given month, the characteristics for a specific subdecile, let's say winners in a particular industry, are calculated by summing up the firm characteristics across all companies within that subdecile. For example, to get the average investment to capital ratio for that group, they sum up the total investment for all firms in that group and divide it by their total capital. This ensures the portfolio's characteristics accurately represent the aggregate economic activity of all its constituent firms.
So you're building up the portfolio view from the firm level, month by month.
Exactly. And then step 3, the final step, averages these subdecile characteristics across the various subdeciles to get the overall characteristics for a full momentum decile for each month. These monthly decile characteristics are then plugged into the model equations to construct the investment returns and ultimately the levered investment returns. So even though the original input data is annual, this meticulous aggregation and alignment procedure allows them to drive a robust monthly investment return that corresponds precisely to the monthly stock returns of the momentum portfolios.
That's pretty clever, actually, bridging that data gap.
It really is. What's also notable about their approach is its parsimony. The model only estimates those two parameters, A and CO. It implicitly assumes identical production and capital adjustment technologies across all firms.
Which might be a strong assumption.
It is. They interpret these estimates as average values across the economy. It makes the model quite elegant and simple in its explanation, but as we'll get into later, this simplicity also has its limitations.
Okay, so after all that sophisticated modeling, and frankly, that incredibly meticulous data alignment, here's the million-dollar question. Does this neoclassical investment model actually explain the momentum we see in the market? Does it truly capture those persistent winning and losing streaks based on fundamental firm decisions rather than just, behavioral biases? And the answer, which might be surprising, especially for those steeped in the behavioral finance literature for years, is remarkably positive.
Yeah, the results are quite striking.
The investment model performs exceedingly well overall. It largely succeeds in capturing a significant portion of the average momentum profits for both price and earnings momentum. Now, obviously, no model is ever a perfect fit for the sheer complexity of financial markets, but this one comes astonishingly close, especially for a framework built on such fundamental economic first principles.
It really does challenge that long-held assumption that momentum must be purely irrational.
Absolutely.
Let's maybe put the numbers on that success, starting with price momentum. If you look at the winner minus loser decile, that classic momentum strategy, long winners, short losers, the model produces a really small model error, or alpha. It's only 0.40% per annum.
0.40%. That's tiny compared to the usual momentum return.
Exactly. To put that in perspective, that error is a mere 2.65% of the average raw winner minus loser return, which is a substantial 15.09%. So the model is explaining over 97% of the observed price momentum effect, on average.
Wow.
And looking across all 10 deciles, not just the extremes, the mean absolute error is also impressive. It comes in at 0.83% per annum, which is only about 6.7% of the average absolute decile return of 12.40%. This quantitative success strongly suggests the model is capturing the vast majority of observed momentum profits, leaving very little unexplained residual that you might attribute to purely irrational behavior or other factors. And for earnings momentum, the results are similarly compelling, maybe even slightly better statistically. The winner minus loser decile there has an alpha of 0.92%. It's, slightly negative, but again, very small in magnitude. It's about 10.9% of the average winner minus loser return of 8.47%. The mean absolute error across the earnings momentum deciles is 0.63%, which is only about 4.1% of the average absolute decile return of 15.26%. And interestingly, while the model for price momentum is technically rejected by a formal statistical test called the over-identification test, the p-value is 0.04, just below the typical 0.05 threshold.
So statistically significant error, though small.
Right. But for the earnings momentum model, it actually cannot be rejected by the same test. The p-value is 0.09, indicating an even stronger statistical fit for momentum based on earnings surprises. And if you were to visualize this, say, plot the average levered investment returns predicted by the model on one axis and the average actual realized stock returns for each decile on the other axis.
You'd expect them to line up.
Exactly. You'd see the points closely aligned with a 45-degree line, indicating the model's predictions closely match reality on average. This visual confirmation just further reinforces the model's strong overall fit, and adding to its credibility, the estimated parameters of the model that offer adjustment cost and offer capital share, they turn out to be economically sensible.
What kind of numbers did they get?
For price momentum, AW was estimated around 2.52 and got 0.12. For earnings momentum, AW was a bit higher at 5.41 and GOT was 0.17.
And these make sense.
Yes. The CU values are significantly positive and fall rationally between 0 and 1, consistent with capital being a productive input. They might be slightly lower than some estimates from aggregate macro studies, but they're well within a plausible range for firm-level analysis. And the alpha values are also significantly positive, confirming that firms do face these convex adjustment costs when changing their capital stock, and the estimates fall within the broad range found in other investment literature. This suggests the model's internal mechanics align pretty well with how economists generally believe firms operate. Okay, so given this impressive fit, the natural next question is, how? How does a model achieve this? What are the specific economic forces at play within these firms that are driving these momentum profits, making them look consistent with rational investment decisions?
Right, what's under the hood?
Exactly.
Yeah.
The authors did rigorous comparative statics, basically, taking the model apart piece by piece to pinpoint which components of that levered investment return equation are most influential. And they found quite clearly that the expected growth of investment to capital is, by far, the most important component explaining momentum.
Expected growth of investment relative to existing capital.
Precisely. To illustrate, think about those winner firms with soaring stock prices. According to the model, these winners consistently have a significantly higher average growth rate of investment to capital compared to the losers. For price momentum, for example, the model shows this growth rate is about 1.15 for winners versus a much lower 0.83 for losers.
So winners are expected to invest much more aggressively relative to their size.
Exactly. It indicates they have more abundant and valuable growth opportunities ahead. And to really demonstrate how critical this is, the authors did a counterfactual test. They asked, what if you hypothetically remove this cross-sectional variation in expected growth from the model? What if all firms had the same expected investment growth?
What happens to the momentum prediction?
It collapses. The winner minus loser alpha for price momentum would jump dramatically from that tiny 0.40% benchmark up to a substantial 9.92%. Almost all the explanation disappears.
Wow, okay. So that's the main driver.
It really is. For earnings momentum, it's similar. The alpha would go from net at 0.92% up to 4.07% if you remove the investment growth variation. This shows unequivocally that the differential in expected investment growth between winning and losing firms is a primary fundamental driver of the observed momentum effect within this framework. Now, the next period sales to capital ratio emerges as the second most important factor.
So future profitability matters too.
Absolutely. Winning firms consistently exhibit higher expected future sales to capital ratios than losing firms. For price momentum, the model shows this ratio is about 4.10 for winners versus 3.16 for losers. This indicates that winners aren't just investing more. Those investments are expected to translate into higher sales and, by extension, higher profitability relative to their capital base.
More productive investments.
Right. And again, if you remove this variation from the model, the price momentum alpha would jump to 6.73% and the earnings momentum alpha to 3.36%. Still significant jumps, showing its importance, though less than the investment growth factor. So these two components, the expected growth in investment and the future profitability captured by sales to capital, they're the real heavy hitters here. They account for the vast majority of momentum profits within this neoclassical framework.
What about the other parts of the equation?
Other factors, like current period investment to capital and market leverage, actually sometimes move in directions that would, in isolation, reduce momentum. But their effects are consistently swamped, just outweighed by the dominant influence of expected growth and future profitability. And things like depreciation rates and corporate bond returns. They tend to be largely flat across the momentum deciles, suggesting they play a comparatively minor role in explaining the core momentum phenomenon itself.
Okay, that's a really powerful explanation for why momentum exists, linking it back to these core firm fundamentals like investment growth and profitability. But here's where it gets really fascinating for me. One of momentum's most intriguing characteristics is that it doesn't last forever, right? That winning streak eventually runs out. And often it tends to reverse in the long run. Past winners become future losers and vice versa. Can this neoclassical model, built on these fundamental firm decisions, also explain why momentum seems to be such a short-lived phenomenon? Because the empirical data, especially for price momentum, paints a very clear picture of this reversal. The average winner minus loser return, it starts off incredibly strong, often around what, 20% per annum in the first month after you form the portfolio?
Yeah, very high initially.
But then it gradually, consistently falls off, drops to maybe 13% by month 6, converges close to zero around month 10 or 12, and then quite significantly actually turns negative after that.
The winners start underperforming.
Exactly. The tables completely turn, past winners start losing, past losers start winning. It's a full-blown reversal. Does the model capture that?
And the answer is yes. Remarkably, it does. The investment model largely reproduces this reversal pattern, which is quite impressive, actually, given that the model was primarily fitted to capture the average momentum profits, not specifically their time-varying dynamics over the holding period.
So it wasn't explicitly designed to capture the fade-out?
Not directly, no. But the model's predicted winner minus loser return for price momentum. It starts at a comparable 18.21% in month 1, then it falls to 10.73% by month 6. It converges to zero around month 15, and then it also turns negative after that point.
Okay, so the timing is slightly different, converges around month 15 instead of 10, but the pattern is the same.
Exactly. While the model predicts it takes slightly longer for the reversal to fully play out compared to the empirical data, the qualitative pattern and the overall dynamics are strikingly similar. This strongly indicates that the firm's fundamental investment decisions aren't just driving the initial momentum burst, but also its eventual fade and reversal. So what's the driving force behind this short-lived nature, according to the model? It links directly back to the low persistence of the expected investment to capital growth spread between winners and losers.
Ah, back to that key growth component.
Precisely. Think of it this way. That differential in growth opportunities, the thing that initially drives winners to outperform, it's not a permanent feature of these firms. It's more like a transient advantage that just fades over time. This growth spread, which, as we said, is the primary driver of momentum, it starts robustly at about 39.5% in month 1. But then it quickly drops to 23% by month 6, converges towards zero by month 13, and subsequently even turns negative.
Meaning the losers eventually have better expected growth.
The model suggests so, yes. This fading growth differential is what causes the momentum effect to diminish and eventually reverse. The underlying economic advantage just isn't sustainable indefinitely. And interestingly, this low persistence in the expected growth of investment to capital contrasts sharply with the persistence of the sales to capital spread.
Profitability lasts longer.
The model shows that the sales to capital spread, reflecting profitability, is much more persistent. For price momentum, this spread starts at about 1.03 in month 1, drops to 0.80 at the 1-year horizon, but remains notably high at 0.59 even at the 2-year horizon, and 0.37 at the 3rd-year horizon. This difference in persistence between the growth component and the profitability component really highlights their distinct roles in shaping momentum's dynamics. The growth drives the initial burst and the reversal, while profitability provides a more sustained, though perhaps smaller, contribution.
That makes sense. And earnings momentum shows a similar reversal.
Yes, similar patterns are observed for earnings momentum too. The data shows the winner minus loser return starting high at 17.85% in month 1, falling to 3.36% by month 6, hitting zero around month 8, and then becoming negative. The model's prediction for the levered investment return also captures this. Starts at 12.06% in month 1, falls to 6.12% by month 6, reaches zero around month 16, and then turns negative. Again, the model shows the eventual reversal, and again, it's driven by the transient nature of those differential growth opportunities between the earnings winners and losers. Okay, so if we connect this back to the bigger picture, it's clear momentum doesn't exist in a vacuum, right? We know from other research that it interacts in complex ways with other firm characteristics, things like size, age, trading volume, credit rating, stock return volatility.
Right. The real world is messy.
Exactly. So a truly robust model of momentum should ideally be able to account for these interactions as well. The authors rigorously tested this aspect. They formed what are called two-way portfolios.
How does that work?
Essentially, they sort stocks first based on momentum, winners versus losers. And then they sort them again based on another characteristic, like size, small versus big. This creates more granular groups like small winners, small losers, big losers, and so on.
So testing the model under more specific conditions?
Precisely. It's a tougher test for the model. Now, it's true that the model's overall statistical performance does deteriorate somewhat in these more granular two-way sorts,
Meaning?
meaning the mean absolute errors are larger, and those formal over-identification tests often reject the model for these specific, more challenging portfolios. The fit isn't as tight statistically when you slice the data this finely.
Okay, so it struggles a bit with the fine details.
Statistically, yes. But here's the crucial and, I think, reassuring finding.
Hmm.
The individual alphas, the unexplained portions coming from the investment model, do not vary systematically with these other characteristics for either price or earnings momentum.
What does that mean practically?
It means that even though the model isn't a perfect statistical fit across every single one of these highly segmented complex portfolios, it doesn't seem to systematically misprice certain types of firms based on, say, their size or age or trading volume. Let's take an example to make that clearer: the interaction between size and price momentum. Empirical data clearly shows that price momentum varies inversely with size. Smaller firms tend to exhibit stronger momentum profits.
Right, the small firm effect within momentum.
Exactly. So winner minus loser returns might be, say, 10.86% for small firms, but only 6.67% for large firms in the raw data. However, when you look at the investment model's alphas, the errors, calculated across these same size tercels, they might be something like 0.19% for small firms, maybe negative 2.69% for median firms, and negative 0.64% for large firms.
So the errors don't follow that small firm pattern?
Correct. Notice that the model's alphas, the part it doesn't explain, do not show that clear, systematic pattern of stronger momentum in smaller firms that you see in the raw return data. This suggests that the investment model, despite the increased statistical noise in these granular tests, is broadly accounting for the interactions between momentum and these various firm characteristics within its framework. It's demonstrating a pretty broad applicability of its underlying investment principles across different types of companies, rather than being a story that only works for, say, large firms or low volatility firms.
Okay, that's really interesting. And for those of you listening who appreciate the deeper connections in finance, this neoclassical model also touches on that often elusive concept of risk in a truly interesting and, I'd say, fundamental way. Behavioral explanations for momentum often struggle to define risk in a consistent or economically intuitive manner, right? They often attribute momentum profits more to investor preferences or cognitive biases rather than a straightforward risk premium.
That's often a critique, yes.
But what does an investment-based approach, grounded in firm actions, tell us about the nature of risk that might be embedded in momentum? Well, the study actually starts by replicating earlier, quite influential findings by Bansal, Dittmar, and Lundblad from 2005. Their work showed that aggregate consumption risks, specifically in firms' cash flows, seem to play a role in interpreting momentum.
The long-run risk idea.
Exactly. Specifically, they found that for price momentum, winners tend to have a higher slope, which is basically a measure of how sensitive a firm's cash flow is to long-term growth in aggregate consumption than losers do. The empirical data confirms this. When you look at stock returns, this slope measure is observed to be about 14.94 for winners versus a negative 3.09 for losers.
So winning stocks seem more exposed to the overall economy's long-term health.
That's the implication, yes. Higher sensitivity to fundamental long-run economic conditions.
Now, to delve even deeper into this connection, Liu and Zhang introduce a novel fundamental cash flow measure. This isn't based on stock prices. It's directly derived from their investment return equation.
So cash flow implied by the investment model itself.
Precisely. This allows them to analyze risk purely through the lens of the economic fundamentals driving investment, rather than just looking at stock price movements. And what they found is quite telling. For price momentum, this fundamental cash flow growth measure indeed shows higher long-run risks in winners than in losers. The numbers are 15.95 for winners versus 4.21 for losers. That results in a spread of 11.74, which is statistically significant with a standard error of only 2.78.
So the model's fundamentals align with that risk story.
They do for price momentum. The evidence is somewhat weaker for earnings momentum, but the same directional pattern is still present. The implication here is pretty profound, I think. This evidence helps interpret why winners might have higher long-run risks, especially for price momentum. It links those risks directly back to the economic fundamentals, to the actual cash flows generated by the firm's investment decisions and growth opportunities, rather than simply observing them as a feature of stock market movements or attributing them vaguely to abstract risk premiums.
So it grounds the risk of momentum in the real economy.
Exactly. It suggests that the higher expected returns of momentum winners aren't just some market quirk, but potentially a compensation for bearing greater exposure to fundamental economic risks tied directly to their investment growth and profitability profiles. However, and this is important, like any sophisticated model trying to capture the wild complexities of financial markets, this neoclassical framework isn't a perfect crystal ball. It definitely has its limitations.
Okay, where does it fall short?
Well, one clear area where it misses the mark, where it struggles to reproduce what we actually observe in the market, is how momentum behaves across different market cycles. This raises an important question. What is the model not capturing about market timing or states?
Ugh.
If you look at the data, studies like Cooper, Gutierrez, and Hamid back in 2004 showed a very clear procyclicality in momentum. Price momentum is significantly stronger in UP markets, defined typically as periods following non-negative prior market returns.
Momentum works better when the overall market is doing well.
Exactly. And crucially, momentum can even be negative or non-existent in down markets. For instance, if you define UP down based on prior 12-month market returns, the winner minus loser return over the next 6 months is, on average, a robust 9.89% in UP markets, but a significantly weaker 2.21% in down markets.
That's a big difference.
It's huge. It's a very robust empirical fact, suggesting momentum is highly sensitive to the broader market environment. But here's the model's struggle. The investment model fails to reproduce this procyclicality.
It doesn't show momentum being stronger in UP markets.
No. In fact, if anything, it often predicts the opposite stronger momentum in down markets. For
Yeah.
example, using that same prior 12-month market return definition, the model predicts price momentum over the next 12 months to be 9.13% in UP markets, but a much higher 15.06% in down markets.
Wow, completely counterfactual. Starkly counterfactual. This is a significant limitation. It suggests there's something about how market states, or perhaps how firms' investment sensitivities, or maybe adjustment costs, change in different economic environments that the current neoclassical framework isn't fully capturing. It might be related to how aggregate risk premiums themselves evolve across market cycles, or perhaps how firms adjust their investment plans more cautiously during downturns in ways not perfectly encapsulated by the model's simple parameters. But it's a clear miss.
Okay, that's a fascinating limitation, especially given how important market cycles feel. But let's unpack another really big puzzle for the model. How momentum interacts with value investing, typically measured by the book-to-market ratio. This is a particularly critical point because value and momentum are arguably the two most well-known, widely studied, and often quite contrarian factors in finance. Seminal work by Cliff Asness back in '97, and then later Asness and his colleagues in 2013 famously established this key interaction. While book-to-market, our proxy for value, and momentum are often negatively correlated, meaning value stocks tend to be past losers and growth stocks past winners.
Right. Despite that negative correlation, both individually predict stock returns with a positive slope. Value stocks tend to outperform growth stocks on average, and high momentum stocks outperform low momentum stocks on average.
It's a crucial interaction. You often hear about combining them.
Exactly. This negative correlation yet independent predictive power is a really key aspect that any comprehensive asset pricing model really needs to explain. You often find that diversifying across value and momentum can be a very effective strategy, precisely because they often zig when the other zags.
Unfortunately, this investment model, at least in its current baseline form, fails to reproduce this negative interaction between momentum and value.
It can't get both right at the same time.
Not really. Let's look at the numbers again. For price momentum, remember those winner minus loser alphas we talked about? If you calculate them across low, median, and high book-to-market tercels, the model gives you alphas of 3.46%, -0.70%, and -6.80%, respectively.
So the model's error decreases as book-to-market goes up.
Exactly. The alphas vary inversely with book-to-market within the model. That doesn't align with the observed data at all. The empirical evidence typically shows positive momentum profits across most book-to-market categories, maybe stronger in growth or weaker in deep value, but not this strong inverse relationship in the alphas. And maybe even more critically, the parameters themselves that adjustment cost on a capital share. The values that fit momentum well within this model are found to be quite different from the parameter values needed to fit book-to-market value portfolios well using a similar investment-based framework.
Different parameters for different anomalies.
Yes. Previous research by Liu, Whited, and Zhang back in 2009, using a similar investment approach, reported that they needed an estimate of over 20 and a COB of around zero point 0.5 to properly explain the value premium.
Much higher than for momentum.
Much higher. Compare that to the A of roughly 2.5 to 5.4 and BOC of 0.12 to 0.17 estimated for momentum in this paper. This significant discrepancy in the required parameter values strongly implies that the baseline model, with only those two estimated parameters, A and wall, is simply too parsimonious. It's not flexible enough. It can't simultaneously explain these two major yet distinct anomalies, momentum and value, using a single, universal set of underlying firm-level investment parameters. This is a significant limitation and strongly points towards areas where the model needs enrichment, perhaps by allowing for more heterogeneity across firms or industries, as we discussed. Now, what's fascinating here is that there's another measure of risk, or at least another key empirical aspect of the momentum phenomenon. It's how winners tend to move together and losers tend to move together. The co-movement aspect. Yep. Exactly. This co-movement among extreme momentum stocks is a very well-documented empirical fact, and it contributes significantly to the power and robustness of the momentum factor as an investment strategy. If all the winners moved independently, the factor wouldn't be as strong. The data clearly shows this. If you look at stock returns, the average pairwise correlations among stocks within the extreme momentum subdeciles, even after you split them by industry to control for common industry factors, those correlations are high.
How high?
Well, for instance, among price momentum losers, the average pairwise correlation for stock returns can be as high as 0.86.
Wow, that's very high correlation.
Extremely high. It means that if one losing stock is having a particularly bad day, its fellow losing stocks in that decile are highly likely to also be having a bad day. They really do tend to sink or swim together, so to speak. Now, the investment model does achieve a partial success here. It does reproduce positive co-moment among these extreme deciles, which is good. It shows the fundamentals are contributing to this shared movement. But the correlations predicted by the model are consistently lower in magnitude than what's observed in actual stock returns. For example, while the observed stock returns for those price momentum losers might show that average pairwise correlation of 0.86, the model might only produce a correlation of, say, 0.52 based on the levered investment returns for these same groups.
So it captures the direction but not the strength.
Precisely. This study does find that factors within the model, like market leverage and corporate bond returns, are quantitatively important for explaining the co-movement it does generate. This indicates that these firm fundamentals contribute significantly to why winning firms move together and losing firms move together. Yet, that remaining gap, the difference between the model's predicted correlation, like 0.52, and the observed stock return correlation, like 0.86, that gap suggests there might still be co-movement among stock returns in excess of what can be accounted for by these specific economic fundamentals captured in the model.
So something else is going on too.
It could be. This excess co-movement might potentially point to other influences not fully captured by the pure neoclassical framework. Perhaps there's still room for behavioral factors like common investor sentiment shocks affecting whole groups of stocks, or maybe there are unmodeled systemic risks that affect these extreme portfolios more than others. It leaves a bit of a puzzle still.
Okay, so having taken this really deep dive into Liu and Zhang's neoclassical model, exploring where it shines and where it struggles, what does this all mean for our broader understanding of financial markets? Does this model definitively prove that investors are perfectly rational after all, and that all these behavioral explanations we've spent decades developing are just, well, wrong? Not quite right. It's more nuanced than that. The study itself is very careful to clarify, with admirable academic integrity, that its evidence does not prove rationality.
Yeah, they're quite clear on that point.
And why? Because a low cost of capital for a firm, which might lead to higher investment and thus higher expected returns in the model, that low cost, could reflect two very different underlying realities. On one hand, it could reflect rationally low market prices of risk that investors demand for that particular firm. Maybe it's just not perceived as very risky.
The standard rational view.
Right. But on the other hand, that same low cost of capital could also reflect the sentiment of irrationally optimistic investors who are just willing to accept a lower expected return because they're overly enthusiastic about a stock for some reason.
So the model sees the low cost, but not necessarily why it's low.
Exactly. The model, because it focuses on the firm's behavior in response to its cost of capital, doesn't directly distinguish between these two potential interpretations of where that cost of capital comes from.
However, and this is a really crucial counterpoint to the purely behavioral view, momentum also doesn't necessarily prove irrationality on the part of investors. The core insight here, I think, is that if momentum stems primarily from the optimal investment behavior of managers.
Meaning the executives running the companies.
Exactly. If the firm's executives are making sensible, value-maximizing decisions about where and when to allocate capital based on their realistic expectations of profitability and growth opportunities, then the observed momentum patterns in stock prices might simply be a reflection of those fundamental decisions. In that case, momentum doesn't have direct implications about whether the individual investors trading the stock are rational or irrational. Managers could be making perfectly rational, value-maximizing choices in response to their firm's true economic prospects, and the resulting stock price patterns and momentum would just follow from those fundamental decisions.
Regardless of whether investors are biased or not.
Potentially, yes. The market price might still reflect those fundamentals, even if driven there by investors who aren't perfectly rational. So the key takeaway is quite powerful, I believe, and it really shifts the narrative significantly. It suggests that managers, on average, do seem to align their investment policies appropriately with their firm's costs of capital. And the momentum phenomenon largely appears consistent with this fundamental economic alignment.
So less about investor psychology, more about corporate strategy.
It offers a robust, fundamental counter-narrative to purely behavioral explanations. It forces us to seriously consider that what looks like a market anomaly, something defying efficiency, might actually, in many respects, be an optimal economic outcome playing out at the firm level, driven by rational business decisions.
Okay, so given that this neoclassical model provides such a compelling framework, offering this really new lens through which to view momentum, where do the authors themselves suggest future research should go from here? How can this model be improved and expanded upon, especially to address those limitations we discussed, like the value interaction?
The authors highlight two primary directions for future research, stemming directly from the model's limitations. First, they acknowledge that the failure to jointly fit momentum and value, book-to-market portfolios, suggests that the baseline model, with just those two economy-wide parameters, A and K, is simply too simple, too parsimonious, as economists like to say.
Needs more complexity.
Right. To address this, they propose enriching the model. One really compelling idea is to introduce industry-specific parameters.
So allow a FIC and CHI to differ across industries.
Exactly. This would allow the model to capture the inherent technological heterogeneity that obviously exists across different sectors of the economy. Think about the vastly different investment cycles, capital intensities, and adjustment cost structures between, say, a software tech startup and a heavy industrial manufacturing firm.
They invest very differently.
Very differently. Allowing for these industry-specific differences could provide a much more granular and potentially more accurate fit, especially for tackling those complex interactions like the one observed between momentum and value, which might vary significantly across industries. The second, and equally exciting direction they suggest, is an international extension.
Taking it global.
Precisely. Remember, momentum and value effects aren't just confined to the U.S. equity market. Asness and his colleagues, as we discussed, documented consistent value and momentum across diverse global markets and various asset classes, currencies, commodities, bonds, international stocks.
So the phenomena are global.
They appear to be. So extending this investment-based model to international settings, testing it across different countries with different accounting standards, different regulatory environments, different economic structures, and estimating a richer version of the model on global data could provide really valuable insights into the universality of these fundamental investment principles. It would be a powerful test of whether the story of optimal managerial behavior driving these patterns holds up across different economic and institutional landscapes around the world. This deep dive into firm-level investment decisions has really offered us a compelling, fundamental explanation for market momentum. It shifts our focus, quite dramatically sometimes, from investor psychology to the strategic choices companies make. But what if this isn't just about stocks? Could this core idea, optimal managerial investment behavior, the rational allocation of resources based on expected costs and benefits, could that also help explain seemingly anomalous or persistent patterns in other complex systems?
What kind of systems?
Well, think about resource allocation in natural ecosystems, maybe, or strategic moves in competitive business markets outside of finance. Perhaps even the growth patterns of cities or the development cycles of technologies. Could the principles of optimal investment explain why some winners keep winning there too?
That's a fascinating thought. Think about it. The next time you see a winner keep winning, or maybe a loser keep losing, whether it's a company, a product line, maybe even a research direction, you might just be looking at a reflection of perfectly rational choices being made about where to put capital, where to invest resources for optimal expected growth, given the perceived costs and benefits. That's a powerful thought to chew on, extending far beyond just the ticker tape. Thank you so much for joining us for this deep dive into momentum and the neoclassical view. We really hope you're leaving with a richer, more nuanced understanding of this fascinating and clearly still evolving financial mystery.